QuickBooks Pro Desktop 2021. Multiple currencies, purchase equipment on account within QuickBooks. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our multiple currency practice file. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. We're now thinking about a transaction where we have a purchase of equipment or depreciable assets, fixed assets, property, plant, and equipment type of assets. We're going to be purchasing them on account. In other words, not paying cash for them, but taking out a payable, needing to pay in the future. Not only that, but we're going to be paying in a foreign currency, in this case, yen. We thought about this transaction in Excel just to think about what the journal entry would look like. The journal entry being fairly straightforward in that we're just going to debit the machinery and equipment and credit the accounts payable as we normally would. However, noting that we're using an accounts payable account here and not, say, a loan account as we go into QuickBooks, because the accounts payable account is an account that will allow us then to set up the multiple currencies in the foreign currency to allow us to use QuickBooks system to calculate the exchange rates. Then we put it on the books, the machinery going on the books at the point in time of purchase using the current exchange rate. Even though we're paying the $400,000 in the future, we're using the current exchange rate at the point in time we're recording the machinery, and that's going to be at the 41.6 for the current dollar amount, and then we're going to increase the payable as well. How would we do that then in the QuickBooks system? So if I go back over to QuickBooks, we're going to be entering basically a bill. We want to enter a bill because that's going to be the transaction that will enter a payable. So again, it's not going to go into a loan. We're going to enter a payable, and therefore we'll enter it with basically a bill. But before we set up the bill, we got to make sure that we have an accounts payable that will be set up for the foreign currency, and make sure that we have the vendor set up properly for the foreign currency vendor type. So to do that, let's make sure we have the foreign currencies on for this particular type of currency, now being yen. Last time we dealt with Canadian currency, Canadian dollar. We're doing our books in the US dollar. So if I go to the list drop down and we say, okay, let's take a look at our currencies, we now have the yen is available. So the yen is on. We could then, if we were doing this in today's time period, then go down to the exchange rates down here and say, I want to take the current exchange rate so that when I put it on the books for the bill, it will then do the calculation converting as of the spot rate for today. So then we would download the latest exchange rates. However, we're doing this kind of in the future, so we're going to have to manually input the exchange rate here for our practice problem. So I'm going to double click on the yen. We're going to say that we're putting this in place as of 8/30x1. So I'm going to put in a new one, 08/30, and I'm going to say 21, and that's going to be then the amount or the rate that we're going to be using in our practice problem. These aren't actual rates, I practice problem. 0.104. So we got 0.104. 0.104. Let's check that one more time. Is that right? Yeah. Okay, so then I'm going to say save on that one. So we save that. Then we got to make sure that we're setting up an account that's an accounts payable account in yen now. So I'm going to do that by going to the lists drop down, take a look at our chart of accounts. We have an accounts payable account down here in US dollars and Canadian. So now we need one that's going to be in yen, in the foreign currency of yen. So I'm going to say, all right, let's make another one. Accounts rise up, new account. And I'm just going to say this is going to be a payable account. Payable account, that's the one we want. And then we're going to say it's going to be accounts payable in JPY, which is the abbreviation for yen. We want to make sure we change the currency field down here to JPY. So there we have that. So Japanese yen looks good. So then we're going to say save and close. So now we have the account setup that we need to be going to. We also need a vendor that we're going to be using as well, that's set up as a vendor who we know that we pay in foreign currency. That's how QuickBooks will know when I go to the homepage and create a bill that it needs to be billing to the accounts payable account, meaning the accounts payable account in yen needs to agree with the vendor that we set up as somebody that we pay typically in that same currency, in this case, yen. So we're then going to go to the vendor dropdown. Let's go to the vendor center. We could set this up, of course, as we go, as we enter the bill, in other words. But I'm going to set it up in the vendor center here so we could just emphasize the fact. So I'm going to say new vendor. So we're going to set up a new vendor, and I'm going to say this is going to be vendor, and I'm just going to say 1, or let's say 2, because I already have vendor 1. That's their name. It's a pretty bad name, but it's going to be JPY, Japanese yen. And then we're going to be saying that we want the currency to be in yen. So this is someone that we pay in a foreign currency. We pay them not in dollars, in a foreign currency. So I'm going to say, okay, there we go. And then I'm going to go back to the home page, and now we can go ahead and enter our bill. So I'm going to enter the bill. We might have to add an account for the equipment account too, but that'll be easy. That'll be easy. So we have our accounts payable bill means that accounts payable is going to go up because we're buying something and we have not yet paid for it at this point. So I'm going to hit the drop down. We're going to make sure that we want the payable going to the yen, which may already just populate when you select the vendor who happens to be a vendor that you're going to be paying in yen. So the vendor we're going to be paying in yen. So we got the vendor lining up to the payable account represented here by the JPY in the vendor account. This then date we said, what did we say the date was going to be? On 8/30/X1 or 21, so I'm going to say 08/30/21. It then says you've changed the date for this transaction. QuickBooks has a different exchange rate. Do you want to use that one? I'm paraphrasing now. We're going to say yes, QuickBooks. So I want to use that date, exchange rate. So then it pulled over our exchange rate, the proper exchange rate for this current date, and then we're going to say that the amount in yen is going to be for 400,000. So we're saying 400,000, and that then will convert to the 41.6 US dollars using the 0.401 exchange rate that we entered as of the date that we're making this transaction. All right, so that looks good. And then I'm going to record the other account, which is going to go into our equipment account, which I don't think we have yet. So let's put in an equipment account, equipment, and I'm going to set that up. It's not going to be an expense type of account, but rather a fixed asset, which is what QuickBooks is calling the property, plant, and equipment. This is it, major purchases, fixed assets. So we'll set that up, and there it is. Notice again, we don't have anything here for foreign currency at this point because the fixed asset is what it is. We're going to have to measure it in US dollars, not in foreign currency. So I'm going to say okay, and there we have it. So what's this going to do? Well, it's a bill. It's going to increase the accounts payable. It's going to increase the accounts payable on our books, not for 400,000 yen, even though we're going to be paying 400,000 yen in the future, but the US equivalent as of today's spot rate, not the forward rate. We're not trying to predict what the rate will be when we pay it, but using today's spot rate, therefore it's going to increase the bill, the accounts payable, 41,600, the current equivalent using today's exchange rate. The other side then, increasing the equipment, a fixed asset account that's going to go on the books as an asset that we will then depreciate for the cost of the equipment as of this point in time, meaning we're going to pay 400,000 in the future, but we're recording it on the books as of this point in time using today's exchange rate, which once again is going to increase the asset for the US equivalent of the 41.6. So let's go ahead and say save and close. Check it out. So save and close. Opening up our reports drop down, company and financial, going on down to the balance sheet standard. Then we'll go to the customization up top, changing the dates from 01/01/21, 12/31/21, and okay. So there we have it, and we then have the equipment on the books at that 41,600, just as we suspected that it would be. I was completely confident that was, and then there's the bill. So there's the vendor. So there we have it. And then the other side, then of course, going into the accounts payable down here, accounts payable, double clicking on that. There we have then the payable on the books for that amount. Now, as we go forward, notice that this payable is now in an account that could then change due to the exchange rate differing because we still have not paid the payable. We owe it in the future, and we're actually going to be paying 400,000 yen. So we're going to have to make some adjustments possibly in the future. Whereas the equipment account, we're not going to touch. We're not going to change it. We put it on the books as of the current value as of the point in time the change took place. So what are we going to do when we change the accounts payable with fluctuations to the exchange rate? The other side then typically will be going to the income statement in gain or loss due to those changes. If we go back to the home page then, the next part of the transaction will be that we pay the bill, of course, with some type of payment, which typically will be recorded in QuickBooks with a check type form, even if we don't use a check, right? We're going to make the payment. and use a check type form, which will decrease the checking account, but we're going to be paying in yen. So we're typically going to be taking it out of a checking account that would be in foreign currency if we were to be paying it in the foreign currency, and we're also going to have to deal with the difference in the exchange rates when that happen. When we do that, right? The difference between the exchange rate at the point in time we make the bill and the point in time we make the payment. We once again might have a midpoint in here, which we'll think about, which would be the cutoff date. What if we don't make the payment and the year end happens or month end happens? We have to make the financial statements, and we have to then make an adjusting entry to correct the accounts payable as of the current point in time, as of the financial statements. And we'll think about those types of transactions in future presentations.